Hello, everyone. Welcome, and thank you for joining us for today's PENTalk. I'm Lizzie Kuhn with Pentegra. Before we begin, I want to go over a few housekeeping items. First, please find the control panel that is located on your screen. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can. Tomorrow, you will receive an email with a link to replay today's broadcast. So let's get started. We are joined today by Rich Rouser, Senior Vice President of Thought Leadership at Pentegra. Rich has more than 30 years of experience in the retirement benefits industry and is responsible for helping to shape and define Pentegra's viewpoints on workplace retirement plans, plan design strategy, retirement success, and employee savings trends. Thank you, Rich, for hosting today. Now let's talk what's in the Congressional pipeline.
Great. Thanks for the introduction, and thanks everybody for joining us this afternoon. We're going to talk primarily about Secure, I call it Secure 2.0. We've talked about this in a couple of prior discussions and presentations. I know we talked about it last year with the group and earlier this year. So there's been, a bit more progress on it. And there are actually two different versions of the bill that we're going to talk about today. There is the bill that was introduced by the House. That's referred to as H.R. 2954, Securing a Strong Retirement Act of 2021, which, obviously this stuff has been evolving over time, and it's been a little bit of a consolidation of a number of different things that have been floating around in the retirement plan space. The other bill is the Senate version of the bill, Senate version 1770, Retirement Security and Savings Act is their bill. So the both bills have overlapping provisions. One, we'll get into the nuts and bolts in a couple of minutes. One has a bit more than the other. And the bottom line is, I've said this before, both versions of this bill have things that are very, very good for the retirement plan industry, for retirement plan participants, and for plan sponsors, quite honestly. So let's dive into some of the items here. So one of the first things that we need to discuss is the fact that ultimately these bills, right, the House version and the Senate version would ultimately have to be combined into, one consolidated bill that Congress, both houses of Congress would ultimately pass. Once that would occur, essentially it could go to the president for signature. So both bills really at this juncture have had big bipartisan support. And, the point is, from my perspective, it's like, when is this going to pass as opposed to will it ever pass? The answer is I think it will pass. I think it'll get signed into law. But as we go along, I'll show you some of the things that are kind of holding things up a little bit, right? So the House bill, again, a little bit more background here, was originally introduced May 4th of last year, 2021, and it was unanimously approved by the House Ways and Means Committee literally a day after it was introduced. On March 29th of this year, the full House voted on the bill, and you can see huge support. 414 to 5 was the vote. They also sent the proposal of that bill to the Senate. And this version, the House version, has 51 retirement plan provisions in that version of the bill. The Senate version, again, introduced over a year ago, just about a year ago, I should say, May 20th of last year. That version or that bill has 59 provisions as opposed to 51 that are in the House bill. And this one has a little bit more in it from the defined benefit perspective. We may be able to touch on some of that today, but I know the way we do PENTalks here at Pentegra, these are typically about 30-minute versions of some of the technical stuff that we would do that might take a bit longer. So we're going to cover highlights and maybe get into that if we can later on in the discussion. So overall, these bills, pretty much just like the original Secure Act back in late 2019, have three big goals involved, right? Number one, first and foremost, of Congress and the administration current as well as the preceding administration, was to expand employee coverage in the United States. There's still a shortage, right, of participation in 401k type plans in the United States among the working population. A lot of employers in this country don't sponsor qualified plans. And I think we've all seen the increase in the number of state-mandated retirement plans that are out there, kind of forcing some of the smaller employers to take some action and do something for the benefit of their employees and make them participants in a qualified plan. So first and foremost, has really been to expand coverage of working population in the United States. It's also obviously to increase retirement savings. And the third component that these bills are seeking to do is preserve retiree income. And kind of as a side note, as the Social Security system comes under, I'll call it, increasing pressure, right? I mean, there are GAO estimates that the Social Security Trust Fund starts to run short of money not too many more years into the future, right? And there's been warnings on everybody's Social Security benefit statement that funding may not be there to provide the full benefits. So I think a lot of this legislative action is truly, I think, heartfelt. Let me put it that way. But given the demise or the downsizing of defined benefit plans over the last literally 30 or 40 years, and the fact that most plan sponsors that run qualified plans are running a 401k type of an arrangement, government legislators are looking to, again, increase coverage and increase the ability of the typical American to participate in a retirement plan. So goals are all aligned. Costs, and this is something I've commented on in the past. I can't think of a single provision in these bills that isn't valuable, right, or beneficial, I should say, from a participant and or plan sponsor standpoint. And you'll see what I mean as we kind of go through some of the highlights of what the items are in these various bills. But these, whatever the final version is actually going to cost a lot of money. And the reason for that is, from some simple things like increasing tax credits to employers for starting a new plan that covers employees. That's real money that the government is going to provide to encourage new adopting employers or new plan formation. Some of the other things I think you'll see as we go along, things like changing the required beginning date for distributions from IRAs and qualified plans, pushing that off by yet another couple of years means that there's going to be deferred tax revenue for the government, right? The government's not going to be collecting revenues or taxable income as soon as it otherwise would because they're simply pushing off that date. So these things are going to cost a lot of money. And again, I think we're running near record deficits more recently. So it kind of puts even more pressure on Congress to kind of figure out how do we get this done in addition to everything else we're trying to accomplish these days. So the HR, the House version of the bill, I should say, does include some revenue offsetting measures, and the cost estimates on the Senate version of the bill have not yet been released, right? But I can tell you this, pretty much every provision in there is going to cost in some way, shape, or form. And just as an additional note, one of the ways the government's been increasing some revenue to offset the cost is by the increase in penalties that are applied for things like failure to file a 5500 annual report timely, and other failures that are relatively common in qualified plans. Increased penalties have gone up by a factor literally of 10. Things that were a penalty of $25 a day, are now penalties of $250 a day, things like that. So more reason to be cautious about complying with the rules and regulations that apply to qualified plans. So we're going to dive into some of the provisions of both of these bills. And again, as I said earlier, expanding coverage in the workplace is one of the critical elements in the plan. So one of the things that Secure Act did is kind of create pooled employer plans, which is kind of a way of saying, hey, here's how you can provide an open map, to qualified employers who want to run a program, defined contribution type of program. But one of the things in the Secure Act basically made the trustee responsible for collecting contributions and coming up with a contribution collection policy. And that's something that most trustees have never really been doing. Trustees and custodians really don't get involved in that side of the business on the call plan side. So this is really just a fix to kind of put tracking and monitoring contributions back to a different fiduciary other than the trustee. So that would be a kind of a welcome change. I think that would open up the marketplace for PEPs a little bit more because I know a lot of outfits that would normally serve as a trustee for a qualified plan have kind of shied away from that due to the increased liability and responsibility associated with that provision that was in the Secure Act. Another thing they're looking to do, and again, this is one of those items that cost money, which is almost every item here. They want to increase the current plan, startup tax credits for small businesses from 50% of the cost within certain limitations, of course. They want to make that up to 100% of the cost for the first couple of years of the plan. So, and again, under the heading of encouraging new plan formation, therefore improving retirement plan coverage in this country. Another fix or simplification element, I should say, is allowing qualified plans to self-correct all, I'm going to emphasize the word all, unintentional plan violations. So right now, and again, I'm not going to go into a lot of detail on this now, but there are various compliance resolution programs that are available to sponsors, but they only cover a limited number of failures. So this is, kind of the intent of saying, look, to be reasonable, there are failures that inadvertently occur due to a variety of reasons, and they're trying to liberalize the rules a little bit, make it easier for plans to comply, as opposed to being subject to egregious fines and penalties and whatnot if they otherwise fall down on something that might otherwise be relatively common and relatively easy to fix. So that would be the good news. Another thing, many small plans are considered quote-unquote top-heavy. Again, I'm not going to go into a ton of detail, but that's when owner employees have more than 60% of the benefits in a defined contribution plan. There are certain rules that force those plans to provide certain minimum contributions to non-owner or non-key employees. So again, this is a way to liberalize that segment of the marketplace a little bit, and again, more likely to potentially encourage small businesses to establish qualified plans. There are a couple of interesting changes and really good changes, I think, to the 403B plan marketplace. One of the first ones out there is to treat 403Bs a bit more like a 401k plan, which are allowed to invest in common collective trust funds. These are similar in many ways to a mutual fund, but they're not regulated in the same way. There are some differences. There's no prospectus per se and things of that nature, things that kind of cost money to support within a mutual fund structure. Collective investment trust, CITs, you might refer to them as, tend to have a lower cost structure in terms of managing and running the fund. So they generally have not been available to 403Bs like they've been in the 401k market. So again, this is liberalization of a rule that would potentially permit that as an investment choice. And another thing that would impact positively 403B plans is the ability to participate in a multiple employer plan, a MEP, or a PEP, a pooled employer plan. And it would also give them some of the relief that is available as designed in the Secure Act back in late 2019 with respect to, if there's one plan in that MEP or PEP that for some reason has a compliance issue or error, that doesn't taint the rest of the adopting employers in the plan. So the bottom line is there's some favorable stuff here for 403B plans that would give them, additional opportunities to potentially run their plans in a more cost-effective, efficient manner. There's also something else in one of the bills here to allow certain companies with liquid securities, to deem their stock to be public for ESOP purposes. Again, I'm not going to get into the detail there. I think that's a very, very small segment in the marketplace, but nonetheless, it's a way of encouraging and expanding retirement plan coverage in the United States. The House version of the bill would mandate automatic enrollment, and there's certain enhancements to the automatic enrollment process here. Improving the savers credit. And again, for a lot of, I shouldn't say, I don't know why, but we don't tend to talk a lot about this, but certain eligible participants in qualified 401k type plans are eligible to receive credits, tax credits, based upon their level of income that's got to be below certain income thresholds, but also based upon the contributions they might be making to the 401k type plans. So there's a look to increase the crediting rate, in that scenario, which would be a good thing. It would encourage more people to participate in salary deferral type plans. I highlighted this one. I wanted to spend a minute or two on this. The bills are looking to reduce the service requirement for, I call this LTPT, the long-term part-time workers. They want to reduce it potentially from 3 years to 2 years. So when we go back to the Secure Act, there was something in there that basically said if you've got, you as an employer and a plan sponsor, have employees who perpetually work between 500, more than 500 hours, but less than 1,000. So for whatever reason, they don't become eligible for your plan, your 401k plan. So Secure Act basically said, look, if somebody's been in that category for at least 3 years running, more than 500 hours, but never enough to qualify to get in, you need to allow them to come into the plan. But again, it was going to be a period of time measured over three years. So they want to reduce that to a 2-year period of time. And again, it's kind of interesting. I almost would have expected that to somehow make its way into the law sometime last year. But nonetheless, it's showing up here again. So, as a plan sponsor, you might say, well, wait a second, what is that going to do to me and my plan? Does that mean, I've got to make a matching contribution? Or if I make additional discretionary contributions, like a profit sharing contribution to my plan, do I have to give it to those truly part-time employees? And the answer is no. This is really just permitting those folks to come into the plan for purposes of deferring salary. So again, the change would be from the 3-year to a 2-year period of time. So the next one I put up on the screen is talking about a national online lost and found for retirement benefits. So, on the defined benefit side of the equation for many, many, many years, right, there's been a method of reporting certain terminated participants who have a benefit due in the future from the defined benefit plan. And that would be, part of a 5500 form filing. And ultimately, if that participant got lost, there was a mechanism in place, right, to kind of find that defined benefit participant, right? So really, this is really an expansion of what the PBGC, Pension Benefit Guaranty Corp, has been doing for years for defined benefit plans. It could be set up as kind of an online national, call it a warehouse, if you will, for finding missing participants. So it's interesting. I think it would be interesting to see them develop is the point. And I think it's something that's needed, some sort of a solution to find missing participants, because we see so many participants who have so many different jobs throughout their careers that there's little pieces of benefits I think left behind. And in a lot of cases, those benefits are forced out into forced cash out rollovers into IRAs, which are sometimes hard for that participant to find. So I think that would be a good thing. Another provision is granting plan coverage to military spouses who change jobs frequently for retirement. So basically allow them to have some mechanism of getting into a qualified plan, with a shorter qualification period to do that. Okay, this one is treating, and this has been going around for a number of years now, treating certain student loan repayments as elective deferrals in a 401k or 403b for purposes of employer matching contributions. I think one of the first companies that did it might have been Abbott Labs a number of years ago, submitted for what's called a PLR, a private letter ruling, to basically get a determination or an authorization, I should say, to consider that, they have a lot of students who are, I should say, a lot of employees who have student loan debt. And because those folks were spending so much of their income to pay off student loans, they really, were kind of putting off or minimizing contributions to Abbott Labs 401k plan. So they basically asked the government to, take into consideration these people are paying off student loans, can't really afford to contribute to the 401k, but we would love to give them a matching contribution in our 401k plan. So basically they got a private letter ruling that said it would be okay to do that. So, and again, literally that was a couple of years ago, even before the Secure Act, definitely before the Secure Act, as I recall. And, there's a lot of enthusiasm around that because, since they got the private letter ruling, doesn't that mean everybody should have that same opportunity? I know one other large company also applied for a PLR. I can't remember the name of it right now. It doesn't really matter. But this concept is making its way back in terms of this legislative effort to basically consider contributions or consider student loan repayments as if it were a contribution 401k, and to allow an employer plan sponsor to consider that in terms of calculating a matching contribution that could go into the 401k or even 403b type plan, right? So, we've talked about this in the past. What are the issues with that? Well, it's great for the participant. Certainly great for the employer, right, who may be looking to attract and retain talent. How much is it going to cost them? Well, put it this way, if those folks didn't have student loans, they'd probably be contributing to the 401k. So I would almost say cost is, it's never a non-factor, but it's probably less of an issue than just the fact that it would be a great tool for retention and recruiting employees to the company. What are the complexities? Complexities would be tracking who has a student loan, how much have they paid on the student loan, and then having somebody do a calculation in terms of how does that translate into the matching contribution. So it adds additional administrative complexity to the plan. I know there are a couple of firms out there that were looking to create a business, right, to help employers, keep track and monitor, so on and so forth. But, the answer is, look, I think it would be a valuable feature to allow. It, I don't think it's being proposed as a mandatory feature, by the way. It would be an optional feature. So, if this goes through, if it becomes law, it would be something that employers could avail themselves of if they wanted to, and if they thought it would be beneficial, and if they had a means of tracking, those contributions that those folks are making towards student loans. So I think it's a great provision. But again, keep in mind, this is yet another provision that, in theory, costs the government money, right? Because if that company didn't make that match towards these people, that would be probably additional profits that they'd be taxed on for the year. The fact that they could make a match to the plan typically would mean it's a tax-deductible contribution. So again, it's almost everything that we're looking at today is going to cost money in terms of federal government revenues and tax receipts. There's provisions in here to increase catch-up contribution limits. Again, we don't have enough time in the PENTalk to go into all the details, but I believe it's age 60 and above, looking to significantly increase catch-up limits for folks in that category for the first, for the last couple of years before they may decide to retire. Here's a flexibility feature in, talking about employer stock and S corps. Again, we won't go into that detail right now, but again, it's additional flexibility potentially being provided. And again, I want to be cautious here, right? Not everything is identical in each of these bills, the House version and the Senate version. Ultimately, they'd have to be reconciled. And some of the additional features that are in the Senate version of the bill that are not in the House bill, again, there'd have to be a reconciliation process to bring them together. And so some of these things that, appear to have been added since the last time we did a discussion on this may or may not kind of last, to the end result. Most of the provisions in both bills are similar, if not identical, but not every provision. Okay, so here's another one that is on the table, is to increase the required minimum distribution age from age 72 to 75. It seems just like yesterday that they moved this from 70 and a half to age 72. Now they're looking to potentially push that off to age 75. So again, additional deferred receipt of tax revenue for the government because of that date, if this provision goes through. Removing RMD, right, required minimum distribution periods for life annuities. So there are certain situations where taking an annuity or converting a balance in an IRA account to an annuity type of payment can create problems in terms of how RMDs are calculated. So I think this is really just kind of a cleanup, fix-it item, if you will. We haven't talked about longevity annuities in a long time, right? But longevity annuities were introduced a while back as a way for defined contribution plan participants to buy, all right, or put in place by an annuity that starts at a much, much later age, right? So basically the concept is for the first 20 or so years of your retirement, let's say from 65 to age 85, you've got a pot of money or a pool of money, you've got Social Security income, maybe there's some pension income, but essentially you could take your assets and kind of plan on spending them down or utilizing them over a period of about, let's say, 20 years, which would be a typical life expectancy in general, right? Range of, period of time for a typical retiree. But in the longevity annuity is the piece that would kind of start at age 85, right? So the concept is you pay a little bit of money now because that annuity, if you're still alive, by the way, would only start at age 85. So it's a lot cheaper to buy that longevity annuity for a couple of reasons. Number one, it's deferred by at least 20 years, maybe longer. And number two, a certain percentage, I hate morbid, but a certain percentage of people die before age 85 and the annuity won't pay. So that's why it's a lot cheaper. But the whole concept of it is the law as written does not allow a participant to spend more than 25% of the retirement asset. And I think there's a dollar cap on it too, but on that annuity contract. So they're looking to liberalize it a little bit or maybe increase that to a degree. And again, under the heading of providing participants with more flexibility in terms of planning their lifetime income. Again, here's a provision. Again, I'm not going to go into detail, updating regulations for insurance dedicated ETFs. Again, flexibility in the marketplace. This one I thought was kind of interesting, or very interesting. They want to modify the regulations for target date funds that use in terms of the benchmarking, let's put it that way, let's keep it simple. So the typical target date fund, right, will maybe benchmark itself against the S&P 500. And target date funds are a blend of, a variety of underlying components, right? So a long dated, meaning let's say a 2065 target fund may very well be 95% equities and 5%, bonds or cash or something like that. Whereas a 2025 target date fund right now is probably 80% fixed income of some sort, right? And only maybe 20% equities. So, and then by the way, a target date somewhere in the middle is closer to 50-50, right? Between equities and fixed income type investments. So it doesn't really make sense to benchmark any target date fund against a specific equity or fixed income benchmark, like an S&P 500 or like a long bond index or whatever it may be. So the whole point here is to potentially use a blend of broad market-based indices. I think that makes sense. I think it makes it more understandable from the participant standpoint. The proof is in the pudding, so to speak, in terms of the details of how exactly that would work, whether there'd be kind of banded ranges of what you can do or I think I'd like to see consistency from one provider to another in terms of benchmarks, but that may not be the case, right? Because target dates come in a couple of different flavors. And again, we won't go into that today, but there's a lot of moving points there. But in general, I think it's good provision. I think it'll be more helpful to plan participants and make benchmarking in those funds more understandable. Another feature is potentially raising the forced cash out limit from 5,000 to 7,000. Right now, defined contribution plan sponsors are permitted to force distributions to either participants who don't reply, to take their money out of the plan, or who may get lost somewhere down the road. So, looking to increase that limitation. I don't know that is a real revenue item either way for the government, but it's just something that's out there. Again, they're looking in this provision for the DOL to review certain fiduciary standards when a defined benefit plan is selecting an annuity provider. We could spend about an hour on how that works, but the quick take on it is if a defined benefit plan sponsor wants to buy annuities, right, for their participants and under the heading of de-risking their plan or terminating their plan, there are certain standards, safe harbor standards they would have to meet in terms of selecting the annuity provider. And as it turns out, never mind the fact that there are hundreds, if not thousands, of different insurance companies out there, it's probably only 8 or 10 that actually meet all of those standards. So to those of you who operate in the defined benefit space where you've been finding, my client wants to shut down their defined benefit plan and annuitize the benefits, but can't find a top tier insurance company that will take on the obligation, and for a number of reasons. Number one, it could be a very small pool of people, right? A lot of the insurance carriers want to do deals that are, $10, $20 million or more. Others don't like the mix of the population in the plan. It could very well be that there's 2 people in pay status collecting benefits. By the way, insurance companies love to annuitize those people because the benefit amount is known. What they don't like is a whole bunch of participants who are deferred, meaning, you got a bunch of people who are 45 years old or 35 years old or 25 years old and entitled to a benefit at normal retirement date, or later, or sometimes earlier. So the starting point of that annuity is somewhat unknown, right, in certain cases. So, plus certain plans have lump sum. Look, there's a whole bunch of complicating factors that kind of limits the group of top-tier companies. So anyway, they're looking to potentially liberalize the standards for, I think, those safe harbor provisions. So, we packed a lot into roughly 33 minutes here, and I think we're a little bit over time for this one. Lizzie, or do we have any questions that might have come up? I know there's one that I have here.
I do not believe we have any questions through the chat box.
Okay. So there is one, right, that came up ahead of this that somebody had posed to me, which is, when is this? Do we think this legislation will be signed, and when do we think that will happen? I know I was asked that when I did one of these last fall, and I think last fall I said, I think it'll happen by year-end 2021. Well, guess what? It didn't happen. And I would have almost thought it would have happened early to mid this year. I truly, at this point, don't think this will happen until the end of this year. I just, again, our prediction right now is there's just so much on the table in terms of reconciling the 2 bills, which I don't think that's the hard part. I think the hard part is finding cost-saving, offsetting measures to how do we pay for this stuff. But I truly believe both sides of Congress, this is, widely adopted by both sides, of both the Senate and the House, and I think they'll be able to reconcile. Just don't know how they're going to pay for it. That's the reason I think this will be more of a year-end law change. So with that, I thank everybody for the time this afternoon. If there's any follow-up questions, you can let us know and we will get to them. But thank you.
Yep. Thank you so much, everyone, for attending. And as a reminder, you will get a copy of this recording emailed to you tomorrow. And Rich, thank you so much for your time, and everyone have a great rest of their day.